Okay, someone asked about the statement of changes in equity. Now, statement of changes in equity. It's not very different from what you do on statement of financial position, specifically under the equity section, where you have the capital, estimated surplus, and the reversion reserve, like it was in this case. What happens is you're supposed to have a statement that shows changes. If I may just draw, assuming that there are three, okay, borrowing from the same question. Okay, you have something like this. Here you're supposed to have details. Okay, then here you have all your equity items. So in this case, we had capital from the government. Okay, we had accumulated surplus. Okay, then we had the reversion reserve. Okay, so this side is supposed to be the total column here. You're supposed to add that. So what happens is you're supposed to have the opening balances, what you call the balance carried down. Okay, if I may just borrow from this information that we had, our opening capital was up to 2.5. Okay, here 2.5. So you come and put 2.5. Okay, I'm just doing for 2015. So for 2014, there's really no changes, so it will be blank. So that's much. To only have opening balances and closing balances, which are the same. Okay, then surplus. Here, accumulated surplus. It is 1845. 1845. Then reversion reserve we saw began with at 785. Can just confirm for you. Reversion. Here. Reversion reserve 785. The others are not equity items. We only have these three. Okay, so your equity statement, therefore, you should have the totals for this. I may just add for you, saying to 500. Add 1845, then add 785. We have that of 130. Okay, then on this, you add any changes that happen during there. So in this case, if you had additional capital, you would add that additional capital and you put the amount. Okay. But we don't have anything to do with capital, but we have reversion reserve. Okay, so here you come and say we had one on land. Okay, evaluation on land. We're just trying to, okay, and it was a gain. So gains always increase evaluation. That's why we ended up crediting it there. So for land, I think if I'm to remember correctly, okay, let me just not remember, let me put the real amount. For land, we had 912 as our valuation gain. So 912 would come there. Okay, then we also had revaluation on building. Okay, for it I remember it is 199. Okay, those were the changes. Then the other thing is we had surplus for there. Surplus for there coming from the statement of financial performance. We didn't find it in my workings, but I expected to find it. So we'll come in and say surplus here. Whatever figure you got, you bring it here under surplus. Okay. So usually there are changes whenever they ask for statement of changes in equity. There's usually a transaction between these equities. Maybe they'll tell you we issued bonus shares or we transferred some revaluation amount to capital, something like that. They always try to compare the two. And once that happens, you know what to do. I can just sample you one. If they said we transferred some revaluation money to capital. If you're transferring to capital, you're saying transfer. Okay, transfer. If you're transferring to capital, if assuming it is 1,000, okay, not 1,000, 100, you'd have here 100, it's coming to capital. And then valuation reserve, where it's coming from, to be a negative, because it's coming from there. The total here will be 0, of course, because when you add this and that, it gets 0. And guys, that is how you do the valuation reserve. I mean, changes in equity. Okay. And then in the end, you need the total here, the final total. So at the end, you have final total, what you call the balance, carried down, closing balances. So here it has increased, hence to 600. Then what do you have here? You have what do you end up with? Okay, because you're supposed to add those. Then for here, deduct and subtract accordingly, still whatever you get. And this total will always be the same. When you add these ones, or when you just add these balances, the three, you get the same total. So that's how the statement of changes in equity looks like. Okay. I hope there are no questions. We can move on to IPSAS 2. Any questions? Okay, so there are no questions. So let's look at IPSAS 2. I don't know much now. Thank you so much. All right. Becky, I don't watch. Statement of changes in equity. What it does, it just shows what has changed during on the equity section. The balance sheet has 3 sections. It has the asset section, equity, and liability. Changes in equity looks at the equity part only, where you find capital, revaluation reserve, revaluation surplus, retained earnings, whatever. Okay, general reserve, all those items must come in the statement. And whenever they come, you begin with the opening balances, like you're seeing here, opening balances, and then you include any changes that have happened during the year. And I was saying, if you have revolutionary gain, for example, here, like we did, it must be reflected on the revolutionary reserve to show it is increasing and changing because of revaluation. Profit for the year, in this case, the surplus for the year, we're saying it's supposed to come under surplus for the year and increase it. Okay. We're saying if there were any transfers within equity sections, transfers, if they say that you transferred some money from, you transferred 100,000 from revolution reserve to capital, this is what you do. You credit capital and debit revolution reserve. That's why it's a negative and it's positive. And then after including all changes, you get opening balance plus all changes to come up with a closing balance. Something with surplus, something with revolution reserve, and something for totals. And you're done. Do we take carrying amount after evaluation from the asset register to statement of financial position? Yes. The final balances after including revaluation is what you take in the statement of financial position as your current closing balances for your assets. And so we have just done. I thought I showed you that. So I hope you're fine. Do I carry the balance, carry down statements? Yes. Now, for changes in equity, the closing balance that you have here as your balance carried down become the closing balances that you're supposed to have under equity. Okay, if you remember correctly, that under revaluation reserve, okay, if I'm just taking you back, let me take you back to my workings. Before we thought of the changes in what? In equity statement. This is what we did. You have your equity section for accumulated surplus. You're saying you have the opening balance, you add the surplus for there to come up with the final figure that you have to write here. Okay, the closing balance. So now this hassle here will be removed if you have the statement of changes in equity. Because the statement of changes in equity shows you clearly that you had the opening balance like this. Now you have added this, subtracted this, and with this, and this is the balancing. So those final balances are the ones that you bring here in your statement of financial position. Okay, you saw how I dealt with the revaluation reserve. I said I had this opening balance, but there was a gain on land and a gain on building. So end up with the total here. So if you have the statement of changes in equity, you don't have to do that in your balance sheet. Rather, the statement shows you clearly you had this at the beginning, then you got the coach, and added this, and then ended up with the closing balance. Right? So I hope I've answered you, Anita and Sharima. Okay. As far as the questions were concerned. If not, kindly feel free to chat again. So let's go to this cash flows. The first question is what I want to discuss. And then we call it night. Okay, it's taking really forever. It's already 11. So for cash flows, IPSAS 2, we have two methods, indirect and direct. You already know how to do this, so I'm just going to do the number. And you ask where I haven't understood. The difference is only on operating activities. The difference between indirect and direct. Okay. So let's start. This was the question. And what they wanted is just two. They wanted it to prepare a statement of cash flows for the year ended 30th June 2014 using indirect method. Okay, so kindly take screenshots for the question because I'm going to be using Excel this time. This is PDF. Okay, so I'll not be coming forth and back. So kindly take screenshots so that if I talk about the figure and you wonder where it's coming from, you can maybe refer to it. Okay, chap. So I hope you're done there. I can go to the next one. Okay, statement of financial position. I hope you're also done there. Then, okay, it's a continuation, but okay, there. They wanted to prepare statement of cash flows using the indirect method. That's the one I'll begin with because it's the common one that they normally ask or use. Then we shall look at the indirect later. So this is your information. Okay, with cash flows, always understand what they want. If you want the indirect method, the steps are: one is to determine or obtain a line that says surplus before interest and tax. Okay, or profit before interest and tax. So the line is supposed to begin with under operating activities, and then the rest follows. So having said that, allow me share my worksheet. Okay, so this is my worksheet. Okay, you have cash flows from draw your pro forma cash flows from operating activities, then cash flows, investing activities, then cash flows, financing activities. Okay, so I said for indirect method, the first thing is to determine the line that says profit before interest and tax. So when you look at our question that was given, when you go to your income statement or statement of financial performance, that matter, and you read through, you'll find that you don't have a line that says surplus before interest and tax or profit before interest and tax. Okay, so what you have here instead is surplus for the period. This is the after expenses. You don't even have gross profit, you don't have anything. The first line is surplus for period. So you're supposed to adjust this one and take it to where you want it. So I want it to be surplus before tax and interest. So what I do is I get this line and adjust for taxes and finance costs by adding them back if they are subtracted, and by removing them, subtracting them if they were added. So I'll come to my statement therefore. Okay, I say surplus. Yeah. Okay, it's 133,800. Right, 133,800. Then what was not included, or what was when you check, if you just need to find that for purposes of all of us. If you check through, you don't have finance. Sorry, you don't have taxes, but you have finance. Okay, what you call interest by the way. Finance costs are the same as interest costs. And it's what you're interested in because you want a line that says surplus before interest and tax. So I come and adjust therefore for finance costs, remove this 16 so that officially I have a figure that says surplus before interest and tax. So I'll come and say, since it was deducted, I'm adding it back. Add back finance costs. We are adding until 16,000. Okay, having done that, you're supposed to therefore determine officially obtain your line that says surplus for interest tax. Okay, under public sector, under public finance and public accounting, you're not going to find their taxes because government institutions don't pay taxes. They would have paid if they were the ones paying themselves salaries, but they're not the ones who pay themselves salaries. It's the public service that pays salaries for public servants. So because of that, it will really be very hard for you to find that you had the tax expense incurred. So we only adjust for finance costs. So we are done there. Now, after obtaining this line, which says surplus before interest and tax, you come to additional information, deal with it, and then go back and move line by line. Okay, so let's go to additional information officially now. So I don't intend to really share the screen again as far as the question is concerned. Okay. Right, but the additional information is reading that Roman 1, plant with an original cost of 3.2 million and estimated depreciation of 2.4 million was sold off for 0.6 M. Now, what is disposal? For disposal, I have already told you that the first thing is supposed to know. Allow me to put my workings just close here. supposed to have the journals in head. That for cost, supposed to debit disposal account, credit asset account. Supposed to know that for accumulated depreciation amount, supposed to debit accumulated depreciation, credit the disposal account. Everything ends up in the disposal account. Then for cash or proceeds, you're saying I'm supposed to debit my cash because I've received the money, then credit the disposal account. I said everything ends up in the disposal account. So these are your journals, therefore. So with, of course, cash flows, T accounts is mandatory. You always have to know T accounts. So since we're disposing of non-current asset, and they're talking about a plant, you go to your balance sheet. This one, first, let me share the screen. Okay, here, plant. Okay, you come to your balance sheet and look for the plant account under your non-current assets. So when you go to check under your non-current assets, what you have is infrastructure, plant, and equipment. This account here is a general account. So whenever they don't give you splits, you treat every non-current asset in this very account. So I'm going to draw a T account, therefore, of this infrastructure, plant, and equipment. Equipment, debit, credit. Okay, pass the balances. It's an asset account, so the opening balances will be on the debit side. The closing balance will be on the credit side. Okay, how much was it? The opening balance is 76,400. The closing balance is 149,200. Okay, but we also have accumulated depreciation. So if you have accumulated, that means that this you must also have the accumulated account still drawn. Okay, in this case, because for it has a credit balance, oh, that's why it's a negative there. Under those balances, it's a negative because you're under assets, and yet assets have a debit balance. So if you have a credit balance, you must be negative in that regard. Share that again. Okay, it's negative because it's under assets. Okay, and because it has a credit balance, that's why it's like this. So you have 42,458. Okay, so I hope we're following. So let me share my worksheet again. Okay, so this is my worksheet. Okay, that's my T account. Or these are my T accounts, two of them. I also have to have a T account for the disposal. Okay, disposal account, debit. Whenever they say disposal of an asset, just know you have to do a disposal account. Determine whether it's a gain or a loss. Okay, so then having drawn the T accounts, you now apply the disposal journals where we debit by cost and like that. Okay, so we can start with the cost. The cost of the asset was given as 3.2 million. The original cost of the asset is 3.2 million. So you come and you say, with the cost, we debit the disposal account, hence come on disposal account and debit it. It's coming from plant 32. And then go to your asset account and credit it. Where is it going? It's going to the disposal account. How much? It is 3.2. Okay. Then the next thing is accumulated depreciation. It is 2.4. So you come and say accumulated debit accumulated and credit disposal. So I'll come to my accumulated and debit it with 2.4. Okay. And so in regard with the disposal of the asset. So to complete the double entry, come to disposal account and say accumulated depreciation on the credit side 2.4. Okay. Hope we are together there till now. Okay. Then the other item that was given is the money, the proceeds. Is 600,000 or 0.6 M. For the disposal, you're supposed to debit the cash account and credit the disposal account. So when I come to the disposal account on the credit side, I'll say cash 600. I'm supposed to debit the cash account. But since I don't have the cash account in this case, I know that it's a cash transaction. So where does it belong? We go to the statement. Sorry, go to cash flows from investing activities and we say proceeds from the disposal of an asset. Okay, can you say from disposal? And you put here 600. Okay, so by leaving it as positive, you're debiting clearly assets. I mean cash, it is increasing. So guys, that's how you deal with the disposal. Okay, if you have any questions, please raise it now as I go to the next thing. Okay, so the next, we look at the next additional information. Okay, otherwise, since you're done with the disposal, you're supposed to balance off this how do we call it? To balance off the T account of the disposal account, because there you are supposed to determine whether there's a gain or a loss. Okay, let's in fact do that first. So in balancing off the disposal T account, you want to determine whether there's a gain or a loss. And we know that these are non-cash transactions, so we shall use it accordingly. Okay, so in balancing off, this side is small, this side is the big one. So we shall say total of 3.2. It will be the same total here of 3.2. Okay, so what is missing? What is missing is the 3.2 minus the 2.4, then minus the 0.6. Okay, it is 200. Okay, so we say this is loss. Disposal. Why is it loss on disposal? Because they're saying it was debited here, sorry, credited. So if you're credited here, clearly you're saying we're going to debit you somewhere else. Or it was debited in the income statement. Okay, so you come here under your operating activities and you adjust, okay, because the surplus contains that gain. Yet that gain is not a cash flow, so we're supposed to remove it. So in removing it, you're saying, did I say gain? It's a loss. It's a loss, so it's an expense. So in being an expense, we're saying it was already deducted from surplus to come up with this figure. So we're supposed to add back so that we remove it, or we remove the effect. Hence, adding back the loss. Okay, 200. It is positive because we are adding it back. And guys, we're done with that disposal account. So for the asset accounts and accumulated, we shall see how we can balance it off. For now, let's look at the other additional information and see. Isn't it? Okay. The other additional information is saying that the entity paid dividends at the end of the year. Okay, with dividends, even if they don't say it, is supposed to be dealt with under accumulated surplus. So as you can see, surplus, there's a difference there. Okay, so you draw a T account for surplus. Let me draw it. Okay, T account for surplus. Accumulated surplus. Accumulated surplus. Okay, first the opening balances. Let's move this because they don't belong here. The opening balance for the opening balance for what? For surplus, it is 95,200, as you can see from the balance sheet. 95,200. Then the closing balance is 145,000. Okay, so you try to balance off the T account. First, before you balance it off, of course, accumulated surplus is affected by the surplus for the year. Okay, so it's supposed to bring surplus for the year first here. And so on the credit side, because surplus for the year increases accumulated surplus, the deficit is the one that reduces. So it would have gone on the debit side. So we bring it here as surplus for the year. We saw it is 133,800 from the income statement. If you remember, surplus for the year. Okay. So you balance it off to confirm whether indeed there was a dividend paid or there weren't. Okay. So when you balance off, you find that the debit side is less than the credit side. Hence the balance is 84,000. Now this is what you call the dividend declared. Okay. Let me emphasize this point. It becomes paid on a condition that you don't have anything like dividend payable or dividend receivable in your income statement. Sorry, in the balance sheet. So when you go to the balance sheet, this particular one, there's nothing like dividend received or dividend payable or dividend outstanding. So meaning that what was actually charged or declared is what was the real paid dividend. Hence, we confirm that here, this is the dividend paid. And dividends paid, we all know that they go under financing activities. So you come and say dividend paid. How much? It was 84,000. Okay. All right, so we're done with the additional information. So because you're done with the entire additional information, you come and try to balance off your T accounts, the ones that you had opened earlier, and then you go to now the balance statements and balance and take off all the balances. So I'll come and complete with this one. Infrastructure for the asset account, when I add the credit side is bigger. Okay, so this balance should be the same this side, meaning that what is missing is this minus opening balance. So we have like a 76. This one we normally call it a purchase. Okay, purchase, because we say since they didn't give you all the information, there must be some information that was hidden that led to the increase in assets. And assets can either increase by revaluation or by purchase or by donations, whatever. Okay, but in this case, they didn't say anything, so meaning it's a purchase. So it's a balancing figure. So whenever we increase in non-current assets, it goes under investment. Okay. Changes in non-current assets are under investing activities. So we say purchased, just non-current asset. 70. So it's a negative 76,000. Right? Then you come to your accumulated depreciation. Accumulated is affected by the depreciation for the year. So you go to your balance, to your income statement, and confirm, was there anything like depreciation during the year? And yes, it was there, and it is 18,000. So of course, it increases accumulated depreciation. Therefore, it will be on the credit side. You come and say depreciation for the year, it was 18,000. It's from the income statement. Those who are wondering, it's coming from the income statement. So when I add, trying to balance off to see if we have the same balances, you'll find that the debit side is equal to the credit side. Once that's the case, then take it the washing. There's nothing like extra depreciation or anything that is unhidden. So, but we know that depreciation is not a cash transaction. Yet it was included in our income statement. So you come and remove it by adding it back. Depreciation is 18,000. Okay, so once you're done there with your workings, now you go back to your income statements and try to go line by line to see if you can finish everything. Okay, so when I go to my statements, I'll begin with the income statement. With the income statement, you don't begin from top, taxes, revenues, no. As far as the indirect method is concerned, you only begin with a line that says profit before interest and tax. Then what falls below is what you look at. That is specifically finance costs and taxes if they were adjusted for. So therefore, it was only interest that was adjusted for. Hence, finance costs 16,000. Okay, so it's supposed to come and cater for it. In catering for it, you're supposed to confirm whether it has any balances in the balance sheet. And when you go to the balance sheet, you'll find that under current liabilities, you have a line saying interest payables. Now, that should tell you that you need to do a T account, pass the balance in the statement of financial performance, and the balancing figure is what you consider as a payment. Okay, so therefore I'll come and say T account for what? For interest. T account for my interests. Okay. Say interest account. Okay, I think the thing is going to shut down for now. I'm not examining it on this link. So maybe you can start on that one in the next link. Otherwise, feel free to ask any questions so far regarding what I've covered so far. Then I comment as we wait for the link to close in a minute. Any questions? Becky, Shakira, Anita, Shamira, any questions? Where has Sito disappeared? Any questions so far? What if finance costs don't have some other information from the statement? How do we read that? Any transactions in the income statement that you're supposed to include or adjust for, if they don't have any information in the statement of financial position, then we assume that what was in the income statement was actually paid. Okay, assume that it's a complete cash transaction. So you take it as if it is the real money, the real cash paid. Okay, Anita, how about